Hey guys, Joseph James here, back again from schooloftrade.com, and in today's 5-part video series, this is video number 4, so we're almost wrapped up with our series here on trade management. But before we talk about video number 4, let's recap where we left off so far. In our first video, we talked about the 3 phases of the move. Now, of course, to understand how to manage our trades, we have to first understand how the markets actually move. In the second video, we talked about the emotional response behind your trade management. We want to understand and, of course, identify how we react to the emotions that affect our trading. In the third video, we learned about the basics of our trade management strategy itself. Quick targets, eliminate risk, position to capitalize on the bigger move of the day. And now, of course, here in our fourth video, right, one more video to go after this, we'll talk about the 2 different approaches, the differences between mechanical and discretionary trade management. Now, of course, this is one of the most important parts about managing your trades, understanding should we be following a simple set of rules or watching indicators, right? How should we be managing our trades? Let's compare and contrast. Now, I'm going to start with mechanical because a mechanical approach is what I follow every day, and I'm going to recommend most of my new traders follow a mechanical approach as well. So what is a mechanical approach to your management? We follow specific rules, which means we are not thinking. No thinking involved. I follow a simple rules, simple checklist on down the line. Now, a mechanical approach means no emotions, right? I have no choice but to follow my rules. I don't care what my gut instincts tell me. I follow my rules. This, of course, promotes discipline and patience. Very important. This is why I think it's best for a new trader, because it's going to make you stay patient and stay disciplined following that simple set of rules, rather than letting emotions jump in and letting you move your stops back, move your targets up, right? In other words, sabotage, right, that trade. Now, of course, a mechanical approach is not going to be as responsive, right? Not going to be as responsive. Because you're not going to be really looking at your indicators, you're going to be following a set of rules, you're probably going to lose a little bit here and there because it's not going to be as responsive, and I'll go over that a little bit later on in this presentation. It's best, though, for long-term success. So you may miss a couple ticks here and there because of a mechanical approach, right? Not going to be as responsive. But in the long term, though, over the long run, you will typically see, especially as a new trader, you will see better results in the long run because you won't be sabotaging those profits based upon the emotional response. The mechanical approach is also best used in high volume days. When the markets are moving, a mechanical approach, guys, nothing beats it. Let's compare this to a discretionary approach. A discretionary approach, okay, has a lot of differences, but there are quite a few similarities as well. Now, a discretionary approach, we're still going to use specific rules, but we're going to be given kind of the opportunity to go outside of those rules and look at specific indicators to make educated decisions. This, of course, means we have more thinking involved, right? I'm going to have to think outside of my checklist and look at different indicators. It allows for emotions, right? Whenever we get outside of those specific rules, it allows for emotions. I let my emotions creep in when I have to make a decision based upon what I see, not what my rules tell me. It, of course, promotes impulses. Whenever I let my emotions get involved, I, of course, now fall victim to impulse trading, letting my emotions guide my trading results. And, of course, it's also more responsive. We talked about how a mechanical approach is less responsive, how a discretionary approach is more responsive. And why I say that is because if you learn how to follow your indicators, if you learn how to use these simple tools, you'll be able to get out of trades earlier and maximize your profits more. So it's more responsive. You'll make a little bit more money in the short term, right? So short-term success will be more prevalent. However, we see a lot of new traders, they try to move from mechanical to discretionary, and they get into long-term trouble. Remember, discretionary approach allows you to go outside of your rules to make a decision based upon indicators and things you're seeing in the market. So if you're not ready, right, to allow that emotions to jump in, to allow, right, the discretionary approach, that's going to potentially make you more money right now, but in the long run, it could lead to a more dramatic decrease in overall profits if you can't really keep those emotions under wraps. So if you can keep the emotions out, you can see more long-term success, but very difficult, right? That's why you see some more long-term trouble there. And of course, discretionary is always best on low volume days. The reason why it's the best on low volume days is very simple. Because in low volume days, we see a lot of choppiness, up and down, sideways, very indecisive price action. We want to be aggressive with our defense, be more responsive, and be ready to jump in, grab that profit, and get out of that trade in a situation where we have low volume chopping back and forth. So usually it can be much better used in low volume days for discretionary as opposed to high volume days for a mechanical approach. Now guys, of course, we're always going to use the same tools, whether or not we use a mechanical approach or a discretionary approach. So we've talked about the differences, right? Some of the pros and some of the cons. We know that mechanical approaches and discretionary approaches are going to use the same tools though. So of course, with a mechanical approach, again, following my rules, I'm going to use this pink line here. Now, if you follow my my drawing tool here, guys, right, you'll see this pink line here. Okay, that pink line right there, that of course is where I'm looking to trail my stop. Okay, so this pink line right here, that's what I'm going to use to trail my stop. And I'm going to move my stop, right? Move my stop to this level after my first 2 targets get filled, right? Very important. After I get my first 2 targets filled, I will then move my stop to that thick pink line there on my trade management chart. And then of course, when it's filled, it will exit my trade completely and I'll be flat in the market. That is a mechanical approach. I know exactly where my stop goes. I know exactly when to put my stop there, and I know exactly how to manage it. I do not go against that very simple rule. Now, of course, with discretionary, a little bit different. In this case, the same thing applies, but now we're looking for indicators to tell us when to get out. We're going to watch for price action to slow down, watch for the indicators to move against us, and of course, look for an early exit or to maximize profit. Now, on this discretionary approach, again, remember guys, we're still going to follow a simple set of rules. However, in the discretionary approach, we are given the opportunity to go outside of those rules, looking for certain things to tell us to get in, get out, stay in, stay out, whatever it might be. And of course, we're looking for a combination of these 3 tools. Of course, on your trade management chart, we have your MACD, right? That's right here. Get your MACD here on your trade management chart. Momentum, of course, on your fast time frame chart, right? Your trade room fast. And then, of course, you got your pace of a tape indicator on your pace of a tape indicator. So 3 things. MACD curls against us, momentum curls against us, and the pace of a tape slows down to red. So guys, as you've seen before, I will use this to get out early to avoid a full stop. I'll use this to get out early to maximize profit and not give the profit back to the market. And you can see here, very similar, but some key differences. Mechanically, I'm following my rules without any variation. Strictly following the rules every time. I move my stop to my pink line. I let the pink line then take me out of the market. However, in a more low volume day where I see things chopping around a little bit, I may want to get aggressive with taking profit, which of course means I'm going to now look for a combination of the MACD, momentum, and the pace of a tape, all signaling me to get out of that trade early. Let's recap. There are 2 types of trade management. There's mechanical and there's discretionary. Now mechanical, right, easier to follow, best for learning when you get started. You lose a little bit of profit, but you lose all the emotions as well, which means it's best for long-term results. Great for high volume days. It works best to let those trades run. So in high volume days, mechanical approach is key. The discretionary approach requires a little bit more effort, a little bit more thinking and reacting, a little more difficult to learn at first, better short-term profits, but if you can't keep the emotions out, guys, it may give you difficulties with more long-term success. A discretionary approach is best used in low volume days to protect your capital and lock up profits, right? In low volume days, I'll use a discretionary approach to be aggressive with taking profit in a low volume, choppy market environment. All right, guys, so what's up next? Now, this is the 4th video in our 5th and final video now of this 5-part series. We'll talk about adjusting your trade management for different types of traders. Whether you be a scalper, a position, or a swing trader, whether you be a new trader or an old trader, trading futures, trading forex, trading stocks, how can different traders now adapt or adjust this trade management style to fit their specific trading goals? We'll talk about that in our next video, so you don't want to miss that. My name is Joseph James, guys. I want to thank you for coming out and watching us stay in the trade room. The room opens up tomorrow morning at 7:45. Hope this video on trade management helped. Don't miss a tick tomorrow morning, guys. We'll see you guys at 7:45 a.m. Bye-bye for now.